Okay, MegaWhale team, welcome back to the channel, guys. Thanks for tuning into today's video. We're going to go ahead and do an update on Bitcoin today. Short-term analysis, talking about the short-term price action, what we can expect in the coming hours to days, as well as a macro update, talking about some macro indicators, discussing the bottom, discussing a potential drop further, and doing a little discussion on the economy and how that impacts asset prices. Before we get into it, guys, head over to the pinned comment down below, click the link. We actually have a 35% off VIP sale at the moment, which is probably the biggest sale we have done. If you're interested in joining our VIP channel, get access to our VIP channel here, all of our updates, trades, all that kind of cool stuff, and our VIP exclusive chat over here. Obviously, we've got around 500 members. And if you want to take a look at our profits, all you need to do is take a look at our track records over here, and you can see for this month alone, we've had some pretty significant profits, 27 trades, 21 wins, 6 losses. Let's go and get into the video. So Bitcoin has obviously come down, retested that bottom, retested that 9-year trend line. And since then, it's been about a few weeks now, close to 2 months, about 2 months now since we've retested that point. And we've gone into a nice steady uptrend ever since. But we failed to get over that major rejection point at 23,800, that being the major resistance, which acted as a weekly resistance, which is indicated by this gray box, as well as where we found a lot of resistance in mid-December 2020. So we've got rejected from there pretty hard, and we've formed what we would call a bear flag, or since it is larger than 4 weeks, we call it a rising channel. So rising channels are essentially bear flags. The difference being a bear flag usually has a little bit more of a neater structure. As you can see, this has a variety of different retests at different points. Bear flags are a little bit more neat, meaning they have at least 3 retests on one side and at least 2 on the other in a more one side traditional pattern. And they generally are less than 4 weeks. So this is a 2-month pattern. So this is a ascending, or what we call a rising channel. Now, the difference between the rising channel and the bear flag when it comes to measured moves, rising channels can be a little bit more conservative in their predictions. We don't generally have the entire flagpole being met. And we talked about this in our last video. We're not going to go over it too much today, but what it is telling you is that even if we do break down from this rising channel, we don't expect the price, or we can expect the price not to go, significantly lower, so like $10,000. Okay, we talked a lot about that in the last video. Go check that out if you want more information. We're going to be focusing a little bit more about, what's happening within this channel today and talking about this pattern in particular. So let's go ahead and dive right in. So first and foremost, we are finding a lot of support at the bottom of this channel, which is really nice to see. And, this is a rising channel. At the end of the day, we do anticipate more likely than not a break downwards from this channel. Now, we don't have 100% probability in trading. There's never a 100% guarantee. Sometimes bearish patterns go up. Sometimes bullish patterns break down. There's about a 75 to 80% chance this pattern will break downwards at some point. Now, we've talked about that already, and we did say we do expect a retest of that 9-year trend line, okay? And we do expect, if we lose that 9-year trend line, for us to come back into this lower range, retesting potentially, anything around 18,000 to 17,600. I'm just going to go ahead and shift this line. I'm not too sure why it moved to this red line, okay? And a new low will only be a new low once we lose this level. So only when we lose this level, that is when a new low is set. Until then, technically the bottom was in here. We can bring up a whole range of indicators in a second to talk about that, but we're going to go talk about the short term to start off with. So what we're looking for on the short term, on the daily to start off with, we would really like to see a daily close, a daily candle get above this range here. So we're currently closing and opening within this range, and this range is sitting around 21,500 to 21,600, and we do have some minor resistance pushing upwards at around 21,800. But our main zone that we do want to get a daily close above is this zone here. We can see this zone has acted as a major resistance prior to that move upwards to about 24,000, 25,000. And it's a range that we would like to push above again if we want to see any sort of recovery within this pattern, a potential move back upwards. Okay, so that is what we're looking for in the short term. We're looking for a daily close. If we don't get that daily close, we do expect an imminent or a faster move down between here and obviously this trend line. So what that means is if we get the daily close above here, we can be more bullish on the short term expecting some sort of pushback upwards up to another resistance. If we keep failing to get this daily close, it becomes ever so more likely that we will break down very soon out of this pattern, okay? So a daily close 21 hours from now, pretty important. Moving on to the smaller time frame, let's go ahead and take a look at the 1 hour. So on the smaller time frame, it is still choppy. It is definitely still messy. There's no clear pattern going on here for a 1 hour. Again, we have that 21,800 acting as that major resistance on the short term, and we have our current resistance range acting between that 21,500 and 21,600, which we're currently pushing in. You can see we've retested this trend line now. Well, we've been about, what, 5 times, which is pretty insane. And we've established a shorter term uptrend over here, which we faked down out of, broken down and pushed back in. Obviously, it is very, very hard to say right now exactly what is going to happen on the short term. We're going to have to go ahead and do a technical analysis because when it comes to the price is very, very choppy. And the more choppy this price is, the more difficult it is to identify any patterns. The harder it is to identify patterns, the harder it is to give you guys any sort of indication of where the price is going, because part of technical analysis, we rely on market structures, we rely on patterns to figure out exactly where the price is going. So from a horizontal, from a zone standpoint, we're looking at daily close above this level here would be bullish. Okay, above 21,600, and we want to get those closes above 28,000. Pushing up from there, we can definitely expect a move back up to around 22,000, that low 22,000 range. This level over here, which we broke down from before, would be that next target if we are able to get above this range here. Okay, keep it nice and short and sharp. So let's move back to the macro. And I talked about this in another video, because we talk about a lot of things, but I talked about this one specifically in another video. A lot of people were saying, Whale, we're seeing a lot of bottom indicators come through now, and I'd just like to bring up a few. So obviously, first and foremost, we have our pi cycle bottom, and the pi cycle bottom lined up perfectly with my prediction, which was at the bottom of this trend line, the bottom. So that's one. Obviously, the pi cycle bottom has indicated the absolute bottom on 2 other occasions. Now, the only thing I have a little bit of concern about on this is that the pi cycle bottom in the last 2 occasions didn't line up with the 9-year trend line. And I don't really have a reason to why that is the case. Coincidentally, that obviously the absolute bottom for price was met on the pi cycle bottom, but the absolute bottom this scenario was as well as the pi cycle bottom and the trend line for what we have information currently. So this could indicate maybe we do actually push upwards again and retest the trend line at some point, like we did on the last 2 periods. You know, we made a low, pushed upwards, we came back and retested a trend line like we did on the last 2 periods, and that could indicate we are retesting that trend line again at some point. It's hard to say for sure. It is something I've been considering and deliberating on for a bit, because I haven't really come to an answer to that. I can't quite wrap my head around that pattern there. I'm not too sure. I don't think we have the information yet to answer that. But if you guys got any ideas, maybe let me know down below. Let me know what you think. Why is it that the pi cycle bottom indicated the bottom these 2 occasions, but wasn't at that 9-year trend line, which it has done this time? Pretty interesting stuff. Anyway, the next one is the hash ribbon, and I talked about how I don't really like the hash ribbons that much, but nevertheless, on the weekly, it has printed a buy signal, and out of I think the 12 times it's printed a buy signal, only twice it has actually been incorrect. We haven't seen an uptrend twice from there. But I did mention in the previous video, we also printed a buy signal around 27,000, and it did actually cancel and go down. It is a lagging indicator again. It can cancel itself out. So we do have to be aware that just because it says buy, it doesn't mean in 2 weeks time from now, that buy signal is still going to be there. It could dissipate, it could go away, and then all of a sudden, we're obviously not bullish on that indicator anymore. So it's important to keep that in mind. Moving on, guys, DXY obviously breaking upwards, funny bit of resistance here at that 109 mark. Obviously a pullback here will be bullish for cryptocurrency, and we'll see a move upwards. DXY is looking quite overextended. Obviously it's been on this parabolic or almost only up mode for the last 4 or 5 months now, which is pretty insane. We could see a pullback from there, but obviously oil prices pushing upwards again could bring inflation back up, and that's something to keep in mind. Anyway, guys, I'm going to leave it there. I'm going to go ahead and play the clip from the previous video. Just a short update from me today, guys. I really wanted to drill in. If you really took anything away from this video, the most important thing to take away is that daily close. We're really waiting for that daily close above this level. If we get that daily close above this level here, we can expect the price to push back upwards. Obviously, our first target will be 22,700. we fail to get that daily close and we're pushing down, our targets do remain as this upper support over here, and as well as that 9-year trend line, which is sitting somewhere over here. It's sitting around $20,000, and obviously we're losing that. We're going down to that new low again, probably double bottoming. Okay, I'm going to go ahead and leave it there. I think that's all I want to talk about. I'm just trying to think if I have anything else to say. Real quickly, actually, the macro for us to flip bullish, we talked about this yesterday. We do need to break out of this macro pattern. So obviously breaking down or out of this macro pattern here, this ascending channel, will occur around this level here. Flipping $30,000 will be the trigger. That will flip the bear market, flip the downtrend, and then we're potentially setting up a new structure, a new uptrend to go into the future. Okay, I'm going to go ahead and play that clip. It's about a 5 to 10 minute clip, all about the economy, all about how the economy impacts cryptocurrency, how inflation impacts cryptocurrency, interest rates, how all of that works. Really, really important you watch that stuff. You've already seen it, don't have to watch it, but if you haven't seen it, I highly, highly recommend it. Stick around for that. And with that being said, guys, I'll catch you next time. Okay, guys, we're going to be taking a quick look at Bitget, and now Bitget is where I personally trade. I highly recommend sign up to Bitget with the link down below. Bitget is probably the best exchange out there if you are a trader. It has a variety of features, and the best things about Bitget are a few things. Number one, it's non-KYC. Well, KYC is completely optional on Bitget. Now, there's a whole variety of exchanges out there nowadays that have gone completely centralized, sharing your personal trading information and information of decentralized governments and different governing bodies. Bitget allows that option to be left to the individual, to the user of the exchange. You can decide to non-KYC, you can decide to KYC. It's completely your choice. Another really beneficial thing about Bitget, and the biggest reasons why I'm sitting here actually recommending Bitget to all my followers, is that it has 0.02% trading fees. All right, this is significantly lower than any other cryptocurrency trading exchange out there. FTX, Binance, can name a bunch more. KuCoin. It is significantly lower, by 500% lower than the lowest exchange out there, Binance. Another big thing, guys, is there's no global restrictions on who can use Bitget. Anyone from anywhere can sign up to Bitget and get access to the entire exchange of all the tools, whether it be futures or spot. No matter which country you're in, you can use futures and spot. If you're in America, for say, and you want to get access to more spot trading pairs, such as Binance Global, and you can't sign up, well, guess what? They've got 250 different spot trading pairs here on Bitget to get access to, and you can get access to all of these. If you're in Australia and you want to access the futures market and you can't trade futures, you can do it here on Bitget. You can get access to the future market and start trading with leverage. And finally, guys, if you do want to sign up to Bitget, go ahead, click that link down below to sign up to Bitget, and you'll get access to the reward center over here, which enables up to $4,000 in rewards by completing 5 tasks. All right, guys, we'll get back to the video. Thanks for listening to that. Because obviously the economy is one of those main reasons. Anyone who's saying the price is going to go lower, everyone who's, I would say, ignoring the fact that we are a major support or whatnot, they're more or less putting more weight on the fact that they believe the economy could drop low. I'm just trying to find, nope, it's on the other chart. Let's go to the DXY. And the economic situation, obviously, guys, it's here and there. It's here and there, right? Obviously, it's getting worse. Obviously, a lot of indicators in the market, especially in the global economy, looking pretty awful, to be honest. Then we've got the financial markets, we've got the interest rates. So everything's kind of convoluted a little bit. There's a lot going on, and it's kind of hard to wrap your head around. But I like to keep it nice and simple and just talk about a few basic principles first before we dive into it. So the basic principle number one is money flows from cash into assets. Okay, so if you're new to the channel, we're just going to explain it nice and quickly. Money flows from cash into assets. Really simple. The DXY rises, we generally see money flowing into cash. And the money comes from the assets. It comes from the risk assets. So when DXY goes up, assets like Bitcoin, cryptocurrencies, stocks, they pull back. And a lot of you now, if you've been in the market for a bit now, over the last few months, you would have noticed this correlation. A lot of people are saying, oh, DXY's up, Bitcoin's down, right? And we're seeing that, play out even more so now when we've had these significant, changes in the systematic risk in the economy. We'll come and talk about it in a second. But DXY up, cryptocurrency down. That's generally what we're seeing in general. And if we go ahead and take a look at our 14-day chart, and I actually want to talk about a few things here. First and foremost, I want to talk about this because let's just go ahead and maybe I'll clean this up a little bit as we go. I'm going to explain it as we go. So essentially, guys, to understand, how the economy is affecting the Bitcoin price, and thus understand how it can, positively affect it. Because we talked a lot about how, in the past, how, all this stuff, interest rates rising, inflation is going to negatively affect cryptocurrency, and how we're going to see, risk assets prices fall. We've been telling you guys this for many months, since last year. We already warned you guys, bear markets in, bear markets coming. We're going down to, $20,000, whatever. And we talked about all of this, and we used this to explain to you guys, not only give you guys the technicals, not only give you guys the updates on the market, but gave you some real evidence or understanding about how the economy actually drives money, how money flows in and out of assets, how it moves around, and why it moves around. So let's talk about this now, because we've developed a little bit in the story. We've progressed a little bit in the story since we talked about it. And up until, I would say, September, because September coming up now, we are expecting a 0.5% basis point hike. And I want to come back and talk about that in a second, because this is a really interesting point. A 0.5% basis point hike is still an increase in the total interest rate, okay? But it's an additional 0.5% on the current interest rate, okay? But it is also a decrease, okay, compared to the last time, which was 0.75, okay, which can be perceived in the economy or perceived by investors as more bullish, as the only reason why they would decrease interest rates is if they expect inflation to decrease. So this is a common trend I want to talk about now before we get started. If inflation increases up over here, interest rates increase, okay? If inflation decreases, interest rates decrease. So we see that correlation. Now, as these change, they have delayed impacts on two things. They have an immediate impact on interest repayments on loans or whatever, but they have delayed impacts on how companies balance their assets, how they manage their cash flows and future cash flows earnings, and how retail also manages their assets and cash flows. As for those entities to have to adjust their positions, they need to feel the effects of that change, okay? They need to feel the effects of that change or the stresses of that change for them to realize they need to adjust their position, and usually they adjust their position after the fact, not before the fact. The reason we got the top, we predicted it was before the fact. They do it after the fact, okay? So what we've seen, interest rates have gone up, interest on debt has rise, companies have sold off assets, okay? This is to keep their balance sheets healthier, increase their future cash flow earnings, to make their companies look more favorable, look healthier, not look like they're dying, okay? Alternatively, their debt to service ratios are decreasing, all right? That is because their interest repayments on their debt, because they've accumulated a lot of assets with debt, okay? On the low interest, when the interest rates were low, now they've gone up, a lot more debt, okay? A lot of interest on debt, their repayments increase, they need to bring those repayments down, they sell their assets to do so. Same with retail. The only difference is retail has faced a different problem. Retail is an entity, they purchase cost of goods. So we have goods and services, food, oil, we purchase those things. Those things start increasing in price because of interest rates, because of inflation. We see, available household cash flow decrease. What happens when that happens? Well, then our debt to service ratios decrease. Okay, if you've got a mortgage, if you've got loans, you have to pay more money back, you have less money coming in, you're spending more money. What are you going to do? Two things. You're going to sell your assets, or you're going to reduce your expenditure on assets, okay? So less purchasing, more selling. And this whole narrative, less purchasing, more selling, has been the overarching narrative of the market for the last 8 months, essentially. And it progressively got worse as time and time has gone. But there's going to be a point where perceived benefit or perceived risk is going to flip. And it's going to flip before it actually does flip. And that's really important, because just as it flipped negative before anyone reacted, it's going to flip positive before people react and see it. And this is what I'm trying to do on this channel here. I'm trying to just analyze everything, trying to get one step ahead of the ball, because we want to stay one step ahead of the ball. We don't have to be correct. We don't always have to be correct, but as long as we've got a plan on both scenarios, we can capitalize on whatever occurs. So one step ahead of the ball. What happens here, guys? We're going to talk about it. So let's talk about this. 0.75, okay, to 0.5 if we go down. How is that going to impact the market? Let's talk about it. So do that when you go back to this chart. And this is, well, sorry, first and foremost, guys, I was going to do a short-term update. It's going to a massive thing, but anyway, this is systematic risk. Okay, so systematic risk drives asset prices, okay? When there's higher risk, people are less likely to invest. As simple as that, okay? So systematic risk measures the risk in the market that you don't have control over as an investor. This measures risk such as inflation, interest rates, monetary policies, tax policies, all those kind of things that you don't have actual impact. You can't alter, you can't change. Systematic risk defines that entire scope of our umbrella term for all of those aspects of risk. Now, interest rates rising, we see systematic risk increase. A systematic risk increase, the return on your investment in comparison to your risk decreases. So if you're taking more risk to get the same return, you're less likely to invest, you're more likely to sell. This is what the overarching narrative has been. This is why money has flowed out of assets and into cash, and hence why the DXY has risen. So there's that linkage we were talking about between before. That's why the DXY has risen. That's our linkage. And that's how we linked it to risk, okay? So now we've got two things, and this is where it gets complicated, because you need to front run the market in a sense when it comes to predicting the bottom, because the bottom is never obvious, the bottom is never exact. There is nothing ever telling you that the bottom is a bottom in regards to the economy and economic data, okay? Markets usually front run everything, all right? They are fast moving, they'll predict the tops, they'll move down before the top's in or the session's in, and they'll move up before the bottom's in for the economy. That's just how it is, okay? They front run, they're very speculative, and they're mostly driven off perception of risk, not actual risk. And this is what I want to talk about, because we have actual risk increasing. Even in September, if we have a 0.5% increase, that is additional to our previous increases. Therefore, our actual risk has increased. But we do have to keep in mind, investors see it as this. If we've gone up only 0.5%, which is less than last period, therefore they must believe inflation is nearing the top. And that is all it takes for it to flip the narrative and the market to start recovering and continue upwards. As long as people believe that inflation is nearing the top and the economy is going to soon reverse, the return on your investment, the risk and reward balance, the systematic risk changes, the perceived risk decreases, the return and risk balance shift, okay? And that is why we saw this move upwards, and this is why we saw this whole move upwards, guys. If we go back to the chart, you know, after, what was it? What am I editing everything over here? This entire move upwards we've seen over here was mainly because of that whole thing. A lot of people missed that bottom part, that 18K bounce, because they didn't understand how that works. They didn't understand that concept. They didn't understand. They're waiting for the market to say, oh, here's the bottom. They're waiting for people to say, oh, inflation's topped out. They're waiting for that. If you wait for that, you'll never get the exact bottom, okay? Okay, guys, I want to take a quick moment to introduce the Become a Trader course at the end of this video. This course was designed by myself and Wolves of Crypto. We put together a whole variety of knowledge to create the most cohesive, understandable, and beneficial trading course there is on the market. If you're interested in learning how to become a trader, if you're interested in learning how to use technical analysis, if you're interested in learning how to apply market analysis to different cryptocurrencies, this is a course for you. We teach you everything from the fundamentals, the basics about what cryptocurrency is, how to trade cryptocurrency, mastering the craft of cryptocurrency, diving into a whole range of technical indicators, market structures, and teaching you how to utilize these when finding trades and applying risk management strategies to become more profitable over time. We even dive into market psychology, human psychology, and provide a variety of different videos and educational content, including courses and quizzes to assist your learning along the way. If this is something you're interested in, guys, go ahead and contact us down below at the cryptoacademycourses@gmail.com. We'll send you an email back with all the course information, the structure, the payment details, and everything else you need to know. That being said, guys, I hope you enjoyed the video today, and we'll catch you in the next one.